Everyone has an opinion about endowment plans. Half the people who have one will tell you it is a good financial decision they made. The other half will disagree. Here is the thing. Both groups are probably right. They just bought the same product for completely different reasons. So in this video, we are going to answer this properly. What is an endowment plan in life insurance? How does it actually work? And is it a good fit for you? By the end, you will know exactly what the real returns look like, who this product is built for, and who should look at something else. And in the last section, I am going to walk you through the 3 questions people ask most before buying one. Let's get started. So let us start with the basics. An endowment plan is a type of life insurance policy that combines 2 things: life cover and savings. When you pay a premium every year, one part of that money goes towards insuring your life. The rest builds up as savings over the years you hold the policy. At the end of the policy, if you are alive, you receive what is called the maturity benefit. That is the sum your policy was set up to pay you. If you pass away during the policy years, your family receives the death benefit. The key thing that makes an endowment plan different from a basic term plan is this: a term plan only pays if you pass away. An endowment plan pays either way. People also sometimes mix up endowment plans with money back plans. Both combine life cover with savings, but they pay out differently. A money back plan gives you a portion of the payout at fixed intervals during the policy years. So you might get some money back after 3 or 4 years. An endowment plan holds the full amount and pays it out in one go at the end. Some basic idea, but the timing of when you get the money is different. Now, endowment plan comes in 2 types. The first is called participating plan. With this one, you get the guaranteed payout at maturity, plus a bonus on top of that. The bonus depends on how well the insurer has done with its own investments that year. The second type is a non-participating plan. Here you know upfront exactly what you will receive at maturity. No bonus, no uncertainty. You sign up knowing the exact number. Let us talk about bonuses for a moment, because there are a few terms that come up here and they can sound confusing. The first is reversionary bonus. This is a bonus the insurer declares once a year as a percentage of the sum assured. That is the amount your policy is set up to pay out. Once this bonus is declared and added to your policy, it cannot be taken away. Think of it like a small addition to your final payout that keeps growing year after year. The second is called guaranteed additions. These are a fixed amount added to your policy for a certain number of years, and they are committed to you at the time you buy the policy. They do not depend on how well the insurer performs. You know upfront what you will get. The third is terminal bonus or final addition. This is a one-time amount that may be added at the point your policy matures or when a claim is made. It's not guaranteed, and it does not apply to every plan. This is the part most people skip, and it is the most important thing to understand before you buy. The honest way to look at any savings product is through something called the internal rate of return, or IRR. In simple terms, IRR tells you the actual yearly return you are getting on every rupee you have put in, after accounting for when you paid your premiums and what you get back at the end. It is not a rough estimate. It is a precise way to compare what your money actually earned over the full policy years. Now you might look at the IRR and ask why anyone would choose it over other savings options. The reason is that the IRR comparison does not account for the life cover running alongside your savings. If you pass away in year 8, your family does not receive 8 years of accumulated savings. They receive the full sum assured. That is not a return on investment. That is financial protection for your family during the years your income matters most. The endowment plan delivers both things together. The IRR reflects the cost of that combination. Is an endowment plan worth buying in India in 2026? The honest answer is, it depends on your situation. Let us take cases where it works well. If you have a specific goal with a clear end date and you know you need something locking you in to stay committed, an endowment plan is built for exactly that. Saving for your child's college in 18 years, a down payment on a home loan in 12 years, a retirement fund in 25 years. The policy runs for a fixed number of years and the maturity payout lands when you need it. with the added benefit that you cannot dip into the money partway through. If you are a conservative saver who wants to know upfront exactly what you will receive, a non-participating endowment plan gives you that certainty. You are not trying to maximize returns. You want a guaranteed number and life cover together in one product. This plan is built for that. Now, let us talk about when it is not the right product. If your main need is the highest possible life cover for your family, an endowment plan is not built for that. A term plan gives your family a significantly higher cover amount for the same premium because the premium is not being split between savings and cover. If you are comfortable managing your savings separately, or if you have a short time frame in mind, a different product will serve you better. Endowment plans are designed to run their full course, and exiting early typically means getting back less than what you paid. If you're about to make a decision on endowment plans today, here are the 3 things worth keeping in mind. What is an endowment plan in life insurance and how it is different from a term plan? An endowment plan gives you life cover plus a savings payout. If you survive the policy term, you receive the maturity amount. If you pass away during the policy years, your family receives the death benefit. A term plan only pays if you pass away. There is no maturity payout. How to choose the right endowment plan in 2026? The right plan depends on 3 things. Your goal, how many years you're saving for, and whether you want a fixed guaranteed payout or a plan that can grow with bonuses. Before committing to any plan, ask the insurer for the benefit illustration. IRDAI, the insurance regulator in India, requires every insurer to provide one before you buy. It shows the projected maturity amount at the standard illustrated rate. Use that number to calculate the IRR and compare it to what you need your money to do. ABSLI offers endowment options across both the guaranteed and participating structures. Is the maturity payout from an endowment plan tax-free? Yes. Under Section 11, read with Schedule 2 of the Income Tax Act 2025, previously Section 1010D, the maturity amount from an endowment plan is exempt from tax. The conditions depend on when the policy was issued. For policies issued on or after April 1st, 2023, both of the following conditions must be met. Your aggregate annual premium across all such policies must not exceed Rs 5 lakh, and the annual premium must not exceed 10% of the sum assured. If either condition is not met, the maturity amount becomes taxable. For policies issued before April 1st, 2023, only the 10% condition applies. The annual premium must not exceed 10% of the sum assured for the maturity amount to remain fully tax-free. If you have heard conflicting things about endowment plans, I hope this video has shown you exactly why both camps exist. For the right person, with the right goal, and the right number of years, an endowment plan does exactly what it says it will. Disciplined savings with life cover built. I have linked ABSLI's guaranteed savings options in the description below. You can use the calculator to see what your maturity amount would look like based on your premium and the number of years you want to save for. And if you want to go deeper on guaranteed saving plans and how they work, the link is in the description. Like and subscribe if this was useful.